Hey there, Iggy the Investing Iguana here. Today, we're diving into the world of CapitaLand Ascott Trust, a hospitality giant that's been making waves in the Asia-Pacific region. CapitaLand Ascott Trust is the big kahuna of hospitality trusts in the Asia-Pacific, with a whopping 8.7 billion Singapore dollars in assets spread across 106 properties in 45 cities and 16 countries. That's like having a hotel in every corner of the region. Despite a dip in share prices, CapitaLand Ascott Trust has been raising dividends for 3 years straight, thanks to the travel industry bouncing back. In fact, their dividends per stapled security shot up by 16% in 2023, reaching a cool 6.57 cents. But how did they pull this off? 2 words, RevPAU and capital recycling. We will be reviewing CapitaLand Ascott Trust's first quarter results for 2024 and do a deep dive in the 6 key slides. Slide 1. This trust is a true global player, with a strong presence anchored in the Asia-Pacific region. It's the largest lodging trust in this dynamic market, diversified across 16 countries. But that's not all, it also has a foothold in Europe and the USA, giving it a well-rounded geographical allocation. Now, let's talk about their target asset allocation. This trust is all about capturing growth as travel restarts, with a whopping 70 to 75% invested in serviced residences and hotels. These are the prime beneficiaries of the travel recovery we're witnessing. But they've also got a stable income base from longer stay accommodation, making up 25 to 30% of their portfolio. Smart move, right? Resilient and countercyclical assets are the name of the game here. Overall, CapitaLand Ascott Trust's positioning seems to be hitting all the right notes. The diversification across regions and asset types, coupled with a focus on the booming Asia-Pacific market, makes them a compelling option for investors seeking exposure to the hospitality and real estate sectors. As an analyst, I'm giving this trust a big thumbs up for their strategic vision and well-balanced approach. Slide 2. Let's start with the big news. In the first quarter of 2024, this company's gross profit rose by a whopping 15% compared to the same period last year. That's a significant jump, and it's all thanks to stronger operating performance and contributions from new properties they've acquired. It's like they've been hitting the gym and bulking up their portfolio. But that's not all, folks. This company has a balanced mix of stable and growth income sources, which is crucial for long-term success. On one hand, they have a solid foundation of stable income from things like master leases, management contracts for longer-stay properties, and so on. This stable income contributed a massive 64% of their gross profit in Q1 2024. It's like having a reliable paycheck every month, giving them a sense of security. On the other hand, they're not resting on their laurels. They've got 31 management contracts for hotels and serviced residences, which means they're tapping into the growth potential of the hospitality sector as it recovers. It's like having a side hustle that could potentially become a main gig. Now, here's the kicker. The higher proportion of stable income during this seasonally softer quarter for transient travel shows that this company is resilient. They're not just relying on one income stream, but they've diversified their portfolio to weather any storms that come their way. Slide 3. Let's dive into this 1Q 2024 performance summary slide and see what insights we can uncover. The key takeaway is that all major markets posted positive RevPAU, revenue per available unit, growth in the first quarter. This signals strong performance across the hospitality industry, with Australia leading the pack at 8% growth in actual RevPAU compared to last year. Looking at same-store RevPAU, Japan is the star performer with a massive 138% year-over-year increase, followed by the USA at 103% and UK at 93%. This suggests these markets maintained high occupancy rates and were able to raise room rates effectively. The slide also shows a well-staggered schedule for master lease expiries. Only 7% of master leases expire in 2024, with the majority, 71%, not expiring until 2029 and beyond. This provides stability and predictability for hospitality operators as they can plan operations without much disruption from lease renewals in the near term. Overall, this performance summary paints a bullish picture for the hospitality sector. With surging revenues and a favorable lease expiry schedule, the stage seems set for continued growth in this space. Slide 4. The image we're analyzing highlights a REIT that's divesting, or selling off, a portfolio of properties at a premium to their book value. This means the REIT is offloading these assets for more than their listed value on the company's balance sheet. In total, we're talking about a whopping 408.1 million Singapore dollar worth of assets being divested at an average exit yield of 3.8%. Now, let's break down the details. The REIT is selling off properties across multiple regions, including 4 in regional France, 2 in the outskirts of Sydney, Australia, 3 outside prime districts of Osaka, Japan, and 1 right here in our very own Singapore. The divestment prices range from a cool 44.4 million euros for the French properties to a staggering 10.7 billion Japanese yen for the Japanese assets. But here's the real kicker: these properties are being sold at premiums over their book value, ranging from a modest 5% for the Australian properties to a whopping 19% for the Singapore asset. That's some serious profit-taking right there, folks. And the best part? The REIT is raking in some serious net gains from these divestments. We're talking 14.2 million Australian dollars for the Australian properties, 1.1 billion Japanese yen for the Japanese assets, and a cool 14.6 million Singapore dollars for the Singapore property. Talk about a financial windfall. So, what does all this mean for savvy investors like yourselves? Well, it could signal a strategic move by the REIT to recycle capital and reinvest in more optimal opportunities. By offloading these assets at a premium, the REIT is unlocking value and potentially positioning itself for future growth. Slide 5. This image paints a pretty picture of a company with a solid financial foundation and a healthy cash position. The key highlights are the strong capital management, robust financing flexibility, and fortified liquidity reserves. The net asset value per stapled security stands at a cool $1.13, indicating a robust asset base. Plus, a whopping 51% of the total assets are hedged in foreign currency, showcasing some nifty risk management skills. The financing flexibility is impressive too, with a gearing ratio of 37.7% and a low effective borrowing cost of just 3% per annum. This suggests the company has plenty of room to tap into debt markets and fund future growth initiatives. The 67% property value unencumbered ratio further reinforces their ability to leverage assets for financing. But wait, there's more. The company is sitting on a massive $1.24 billion in total available funds, including $474 million in cold, hard cash and $761 million in available credit facilities. This liquid war chest gives the company the financial agility to navigate any market storms and pounce on opportunistic investments. Overall, this capital management slide paints the picture of a well-oiled financial machine with a strong capital base, flexible financing options, and a healthy cash cushion. Slide 6. As you can see from this slide, the company has a well-staggered debt maturity profile and diversified funding sources. They've struck a balance between bank loans, 66%, and medium-term notes, 34%, giving them flexibility in managing their debt. Additionally, a staggering 82% of their debt is on fixed rates, which helps mitigate interest rate risks. But that's not all. The weighted average debt to maturity stands at an impressive 3.9 years, indicating a prudent approach to managing their financial obligations. This company is clearly playing the long game, ensuring they have ample time to meet their debt commitments without any hiccups. Now, let's talk about their liquidity management strategy. They've diversified their funding sources, relying on a mix of bank loans and medium-term notes. This approach not only spreads their risk but also gives them greater financial flexibility to navigate market fluctuations. One key update worth noting is that proceeds from recent divestments have provided them with greater financial flexibility. Additionally, some of these proceeds have been utilized to pare down higher interest rate debt, delivering immediate accretion. Smart move. However, their average cost of debt has increased to 3%, mainly due to a higher proportion of GBP and Euro debt arising from new acquisitions. But hey, that's the price you pay for growth and expansion, right? Overall, this company's capital management strategies are on point. They've got a well-diversified funding base, a manageable debt profile, and a proactive approach to mitigating risks. There you have it, folks, a behind-the-scenes look at one of the biggest players in the hospitality game. CapitaLand Ascott Trust is definitely a force to be reckoned with, thanks to their savvy moves and impressive performance. Now, I know all this financial talk can be a bit overwhelming, but don't worry, that's why I'm here. If you found this video helpful and want to stay in the loop on all things investing, be sure to hit that like button and subscribe to my channel. And of course, feel free to drop any questions or comments down below. I'm always happy to chat about money matters and help you navigate the wild world of finance. Until next time, this is Iggy the Investing Iguana, signing off and reminding you to always do your research and invest wisely. See you in the next video, Money Mavens.